In August, China's export growth slowed more than expected, while imports stagnated, pointing to a bleak global economic picture and weak domestic growth hampered by COVID lockdowns and a property slump. What measures will China take to recover from this collapse? Let us know in the comments whether you think China will be able to get through this. Let us dive in and know further. Hey intellectuals, welcome back to Finance Basics. In today's video, we are going to analyze how China's economy imploded. Exports in US dollars increased 7.1% year-on-year last month, the slowest rate since April, when a lockdown in Shanghai disrupted shipping and far lower than economists had predicted. Imports increased by 0.3% last month, leaving a trade surplus of $79.4 billion. Exports are slowing. China's export growth is slowing but is still far above pre-pandemic levels. General Administration of Customs is the source. China's slowdown is reverberating around the world, with weak import figures indicating bad news for major commodity producers like Australia and Brazil. Leading manufacturers such as Germany and South Korea are also experiencing lower Chinese demand. At the same time, global demand for Chinese goods is dwindling as consumers reduce their spending due to rising inflation and shift away from pandemic-related goods and towards services. Factories in Europe and the rest of Asia are also decreasing output. With the problems in Europe, the global economy is slowing down, so double-digit export growth in the past is not sustainable, said Zhang Jiwei, chief economist at Pinpoint Asset Management Limited. Single-digit export growth is more likely in the future, he predicts. Zhang believes that in order to achieve faster economic growth in the next 12 months, China's domestic demand must play a larger role. That would be largely determined by the government's relaxation of its COVID-0 policy, he said. A silver lining for many countries is that China's imports of energy products such as natural gas, coal, and oil products have fallen by double digits this year, helping to keep global energy prices in check and reducing inflationary pressure. China's exports to the U.S. fell 3.8% year-on-year in August, the first drop since May 2020. Exports to the European Union performed better, increasing by 11.1%, as China supplies more energy-intensive goods such as aluminum, which has become more expensive to produce in Europe. Nonetheless, the increase was less than half that of the previous month. Extreme weather and COVID outbreaks in China also impacted exports. Some factories in Sichuan province were forced to close due to power outages, while virus outbreaks prompted lockdowns in places like Yiwu, a major manufacturing and exporting hub in Zhejiang's eastern province. After 2 years of exceptional growth, China's export growth is returning to more normal levels, said Lu Ting, chief China economist at Nomura Holdings Incorporated. A smaller trade surplus in the future will weigh on the currency, which has fallen this year and is on the verge of breaking through 7 to the dollar. The People's Bank of China has recently taken several steps to slow the yuan's depreciation, including setting the currency's reference rate at the strongest bias on record on Wednesday. China's exports to Russia increased 26.5% year-on-year in August, as Chinese brands filled the void left by departing Western firms. Exports to Taiwan fell for the first time since January 2020, as China suspended some trade in early August in retaliation for U.S. House Speaker Nancy Pelosi's visit to the island. Smartphone, home appliance, and semiconductor export volumes all fell by around 10% in the first 8 months of this year, falling from a high base as sales of those products were previously fueled by pandemic purchases. According to customs data, car exports have remained resilient, increasing by 56% in value this year, making it one of the fastest-growing export products alongside rare earth and aluminum. Higher export prices, rather than increased volumes, may be playing a larger role in driving up the figures. According to Macquarie Group Limited, price effects accounted for roughly half of headline export growth. Price influence. Higher prices rather than volume are increasingly supporting China's exports. Because the export price index is calculated using yuan data, its rise may also reflect the impact of a stronger US dollar. A slowdown in exports puts additional strain on the economy, which is already dealing with a halting COVID reopening and a year-long property market slump. Last year, net exports accounted for roughly 1/5 of China's GDP growth. Economists predict that GDP will grow by only 3.5% this year. We maintain our cautious view on China's export outlook due to the softening semiconductor sector and potential weakness in external markets, said Betty Wang, senior China economist at Australia and New Zealand Banking Group Limited. And that's it for today, guys. We sincerely hope you enjoyed the video. If so, please click on the like button and share it with your friends and family. If you have any questions or comments, please share them with us in the comment space below. Also, don't forget to subscribe to our YouTube channel to see even more of our incredible videos. You can also check out our other videos that have been specially selected for you. We'll catch up in the next video.